Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in and take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com. I dive in there, look for investment opportunities, share all those opportunities with everybody in the community. I try to answer your guys' questions as best to my knowledge. I've looked at these markets for, I'd say, a good 20 years plus. I started investing when I was 22. Didn't know very much back then, but definitely progressed quite a bit from the beginnings, that's for sure. Um, if you want to see how I'm positioning for what I think the big long commodity bull market is coming, sign up. Special is the coupon code. You get a 50% discount on the first month only on the monthly membership, and you get a $100 discount on the yearly membership. And you can always swap from a monthly to a yearly. So coming on down, it says, "Dear son, when you start making money, spend a lot of money on the things you use daily. Laptop, desk, chairs, sofa, bed, toothbrush, food, phone, clothes, gym membership. This will help you level up 10 times faster." I don't know if it'll help you level up 10 times faster, but I do think it's a good thing. You want to spend the money on the things that you use the most. That doesn't mean you go out and get a big expensive car. I'm talking about real change. I should say, maybe not change, but things that will progress your life for the better, given how often you use it. So it's kind of like a finding value. I've got my name there, finding value. It's what value or what money spent increases the most amount of value in your life. And these are the things that you touch daily. So these could easily increase the value quite well in your life. And that's kind of what I've done. I've done the same thing. And the things that you do the most, you also want to get the most efficient at it. Brushing teeth, washing yourself, doing all these things. Yeah, I mean, I don't like doing all that stuff. It's kind of like just a routine, but it'd be nice to get that routine down, less cycle time. Rob Keene says, "Got gold. Gold is on track for the biggest annual gain since 1979." So a lot of people they like to talk about prices. But gold is on track for the biggest gain since 1979. And this is how people view the world. They look at data, they view the data, and this is what they see. I want to show you something. I'm going to show you a couple of charts that support what I call is the big long. The big long is the precious metals commodity bull market that I think we are in and will materialize. There are some ratio charts that haven't broken out yet. And I think we're at the beginning of these big breakouts. And if they do break out, I'm not exactly sure that we will recognize the world that we were in before that. Or sorry, we will recognize the world that we were in before that, but we're not going to recognize this world that we're going to be in. It's going to look a lot different. It's going to feel different. It's going to be different. So here's a couple of ratio charts. And I'm not saying that ratios are the end all be all, but they do tell you when things are outperforming and underperforming, and they do have patterns that we can try to recognize. So here's the pattern that I'm pulling up. This is gold priced in M2 money supply. Why does this matter? Because when gold counts for the M2 money supply, it goes all the way up kind of to the top here. That's like going back to a gold standard type move. And when gold is in a market condition like a declining interest rate environment, everything's financialized, money goes and flocks over to the S&P 500 and financial assets, gold underperforms. So we saw that from a declining interest rate environment from like basically 1980, the peak here, all the way down to the bottom of 2000. That's an out of cycle move for 20 years. 20-year out of cycle move. Then we did a bottoming pattern. The bottoming pattern from 2000 to 2011, that was in a bottoming pattern. That wasn't like a full scale breakout. It was in a bottoming pattern. Now, I can read charts, and I think that gives me some advantage over others that can't. It doesn't mean that I have the biggest advantage of all. It's just it's one advantage. These patterns, this double bottom that we were staring at, they happen all the time. Usually, what you get is you get a falling wedge on the left-hand side here. It looks something like this. Get a falling wedge, and then you go into a double bottom here. I mean, that is the pattern that I see. It is a double bottom. And the beginning of that, usually this falling wedge this is your bull market. That's a different market condition than this one that it falls under. Here is your bottom. That's your double bottom with the booty. So that's like, think of it like you're seeing someone sitting from behind, and they're sitting their butts are butt. That's the bottom. So that's the pattern I'm seeing. And what is coming here is not a bottom. It's coming out of the bottom, perhaps. How do I know it's coming out of that bottom? It's interest rates that are driving it. So when you go look at like a 10-year yield, so this is your 10-year yield. Let me do this. I'm just going to click it, go back. And then I want to, oh, come on. And then I want to put this in a new pane. All right. So this was an increasing interest rate environment here. And then when gold was freely traded, it went berserk. So think of this as like financial or gold suppression. And then it ripped. Then we went into a declining interest rate environment, and that's what this is. And this bottom was created under a declining interest rate environment. It was still going down, if you see that. Now we are in an increasing interest rate environment. The downtrend's been broken, and I think we're going to go upwards just like we did during this first half here. So I'm piecing together all this information and then piecing together this pattern under this market condition. The consolidation is this whole thing. It's the recession, the double bottom, and then this here is going to be the breakout. That's where the big money's made. Now, I go around and I look at other things because I think that the cycle, we're in another cycle here, and gold divided by the M2 money supply is accounting for the money in the system here. It's going up. I've talked about this even in 2020, 2021, all my old videos too. Check out this one. This is XAU USD divided by the S&P 500. This is a very long-term chart. So what this is, and I'm the one who put these lines here. I think that this is a 3-hump consolidation falling wedge. You guys see that? It's a falling wedge because it is declining downward like that. If you see that, right? Now we were looking at the M2 money supply, in gold. This is gold and the S&P 500. This is financial assets. So in this environment, we were in a consolidation the entire time. Since 1929, we've been consolidating against the S&P 500. Precious metals has potential. That's kind of how I'm reading this. And then when we break out of this, holy smokes. I mean, this is like a completely different world that people won't even recognize. Everything that people have known has been in a condition of a consolidation of gold versus the S&P 500. Think about that for a second. And if we can break out of this world over here, and I don't, I try to make reasons for it. The only reason that I can come up with, there's a couple of reasons that I can come up with. And the reasons are we have a massive debt problem and gold's going to just completely completely outpace financial assets like the S&P 500. That's one. Two, um, a combination of debt and a combination of resource constraints in the future. And when you pair those two off against each other, you get this vertical move where people realize that we can't grow at an infinite rate like our money supply has to, and supply is constrained, which then everyone rushes to hard assets or physical assets because they know that the supplies can't keep up with the money printing. Then that's more of a money printing problem too. And then number three is just you have supply constraints. It doesn't matter what the money side's doing. And those constraints, maybe it's oil or maybe it's oil and copper, or maybe it's like 5 or 6 different major materials in the market. And when people realize that you have resource constraints, they look at their companies that they own in the S&P 500 and they say, okay, well, what's Apple worth if they can't get the silver that they need? What is company XYZ worth if they don't get adequate copper material uh, for that? And some of these companies, when you start to discount future cash flows, they start to question the valuation of those future cash flows. So they'll say, well, we were pricing Apple at a PE ratio of whatever it is, or NVIDIA, but I think there's major risk to the inputs of these companies, which then the pricing is all mispriced in the market, which means maybe people are less willing to pay up those premiums for S&P 500 stocks. And that means that the whole index, the whole thing has to change. The 500 largest companies won't necessarily be financial or tech companies. They might be something else. They might be resource companies. They might be very large gold producers, or maybe it's oil producers or whatever. I don't know what it's going to be. But those are options. I don't know if that's going to be the case. I'm just throwing stuff out to try to make logical reasoning of why we have a falling wedge and a potential breakout here. So we've got that big double bottom, the gold to M2 money supply, which means that gold is accounting for the money supply, and we're in a certain market condition. It's already occurring. This here hasn't broken out yet, and I think it will. And it's squeezing in a falling wedge, which means that hard assets, or at least gold at a minimum, could massively outperform the S&P 500. Let's try gold versus the NASDAQ, just for the heck of it. This is the NASDAQ Composite Index. And let me hit this. And there's another double bottom. So you can see, and I'm just going to draw it real crude here, the falling wedge into a double bottom. And this is more or less the same pattern that we see in gold divided by the M2 money supply. So when the market condition comes, and I think the NASDAQ's in a bubble, this is going to go up. And then it's going to probably break out of here too. We could have a pause here. A lot of the times you'll come up and it'll do something like this and then go, or it can do it below, or it can do it above. Or it can go above and below like this. I don't know. No one knows what it's going to look like, but usually does something like that. We're seeing patterns like that across a whole bunch of different things. But this year, this is signaling that gold's going to have a very huge outperformance against the NASDAQ. It is literally the imprint of herd mass psychology. It's all here in the chart, and that's a double bottom chart. Like, that is a picture perfect psychological herd double bottom. I mean, like that is picture perfect. Like, you can't get any better than that. And what we went through from 2000 to 2011 was just a little blip. It was a bottoming pattern. That's all it was. The real thing that's coming next, oh my God, this is going to be an unrecognizable world. It's like you better be in this stuff or you're going to be left behind type of move. Now, I also look at other things, right? Gold is one aspect. Let's try XAG USD divided by SPX and see what that one is. So this is silver divided by the S&P 500. What do you see there? It's signaling something very similar to gold. So now what we're doing is we're building evidence. We're building, I call it confluence, which is the merging of a bunch of information into uh, an idea or opinion or a theory or whatever. And I cut this off because, maybe this was just created by like a super spike where people got afraid or whatever. But anyway, this is a consolidation here, and we could break out of this big falling wedge because the wedge here is falling. You guys see, there you go. It's angled downward. That's a bullish for a move higher. So that looks interesting, doesn't it? So we've got gold versus Nasdaq, gold versus S&P, gold versus the M2 money supply, and now silver versus the S&P. Now, what about oil? Oil is a very inflation sensitive asset, right? Let's do oil versus the S&P. Uh-oh, we got the same damn chart. We got the same chart. Oil versus the S&P 500 is squeezing into a corner and it's about to break to the upside. This is so ridiculous when I start to piece this all together. Now, I pieced this a while back. I'm just showing some of it now. And if we get these breaks like this and gold goes ballistic, silver goes ballistic, platinum will go ballistic, oil is going to go ballistic. These are all squeezed up, guys. I mean, this is dynamite. They're all in these big falling wedges coming down to that corner there. There are all these big falling wedges coming into that corner. And when you squeeze up, this is your squeeze. And then it's going to be boom. It's going to be go time. That's where I think many, many decades of returns could happen in a very short period of time. That's what usually happens in commodities. And this thing is wound very tight. It is wound, baby. There are even very compelling chart patterns in the individual equities that I see. And I share some of those charts on the Discord that we've got on the website there. And obviously, I share them with the Q&A sessions. But guys, this is ridiculous. Look, that's U.S. oil versus S&P right there. Now let's do U.S. oil versus the Nasdaq. Let's see what that looks like. The Nasdaq Composite. Oh, what is that? That's a falling wedge into a double bottom. And then, so this pattern, I would consider to be a dream. It's a dream to get this type of pattern or ratio to be as clean as it does. Now check this out. This is a dream one on the bigger, longer term. We go into the short term. That's another dream. It's this falling wedge into another double bottom. And then we go in and it's another falling wedge on the right-hand side here. See that? Another falling wedge. And we're trying to bottom out and turn higher. Soon, I think. So this is a dream within a dream within potentially another dream. We got to put in the bottom and turn. So this thing, I mean, what this is you get a double bottom, you start to come up. Gold is leading this because gold's already started that move against the M2 money supply. We could go all the way back up here of oil outperforming the NASDAQ. And that would be the unloading from the absolute bottom here all the way back up. And I don't think anyone is ready for this. No one is talking about this. No one. Now, the time to position is down here where we're at and before that, because I think the equities have already bottomed because they have charts that are similar to these. This is ridiculous. This is the biggest long I've ever seen of anything in history. Not a single person who has been born today has had a setup like this. Not a single one. I mean, maybe the setup here going down for US equities that would have been the setup for US equities all the way to 2000, or even where we are today, because it's a double bottom. This would be a double top if we invert it. So if we were to invert it, what this would look like is it's going to be a big double top. So this was the Nasdaq outperforming. Then we had another huge move lower, and then what I think this will be is an eventual, double top like that, and it will be a big crash on the back end where oil just absolutely outperforms. So those, I've been looking at these things, and I call it the big long for commodities and precious metals. So people view the world like this. That's not how I view it. I don't think that's like when you looked at those charts and the way that I explained it, and you go and you look at this, it's like this doesn't tell me anything. Like, what use is this? Oh, it's gold's on track for the biggest annual gains. That doesn't tell me anything. Like that. I mean, what this is when you do these ratios, this is like, whoa, you got it squeezing. Whoa, it's really cheap. Whoa, look at how this is moving through time. This is like, I don't know. I mean, I see these charts, people are sharing all these things, and most of them are short-term oriented. I look at it and I'm like, well, what value is this? Like, who cares if gold's on track for the biggest thing? I mean, that's great, but it's all relative. Relative to what? Let's look at it against the S&P 500 or the Nasdaq, or against the empty money supply, because that will tell me different things. Another thing to also keep in track here, platinum versus gold ratio. We are very, very low, and this generally outperforms during an inflationary environment. And I just showed you all of those charts, like oil versus the S&P 500 and Nasdaq, and all these different charts, right? Gold does really well right before the inflationary move. That's the safe haven asset. If we start to see this break higher here, which I totally think it's going to happen like right now. I think where it's right in front of us, this thing could unload. I mean, it could be big, big. And I don't know if people understand the gravity of what I'm trying to show here. A lot of people, what they want to know is they want to say, well, what's your price target? Give me a time, do this. It's like, well, that's not really how I invest. I invest by looking at anomalies in history, which we're at right now with platinum to gold ratio. And then I look to see how they could unwind. A lot of people, they focus on like prices, and it's like, well, it's all relative. The pricing's all relative. What you want to see is you want to gain purchasing power of platinum. Now, I haven't done this ratio, but let's do it for the heck of it. This is platinum divided by S&P 500. There's your double bottom. And we've broken out of this double bottom here just now. Like, these are all set up and they're all starting to break out. It's all just ridiculous, guys. It's all just ridiculous. The confluence, the way that these things are moving, these double bottom patterns, and I hate to say this, guys, but this could be a launching pad where we get up like this, we go all the way up here, and then launch higher. This could be absolutely ridiculous. Like, I'm handing people gifts here of all this stuff that I have researched. It's just a gift of knowledge, a gift of being able to see this stuff, being positioned where we're at to take advantage of this. Yeah, this is all just ridiculous. Um, so here's the Fiat Archive. Former finance professor Tad Smith. After 25 years teaching finance, I realized at 58, if the money printer grows 8 to 10% annually and the S&P 500 returns 9%, it's just treading water. True wealth comes from outpacing the printer. That's the Bitcoin journey, is what he says. What I've found, and this took me probably till 30 something years old, is that these guys don't know that much about what they're talking about, finance professors and a lot of other things. So what I did is I dove in and figured out the markets myself. I think he's going to be drastically wrong. I don't think Bitcoin's going to be the journey that you want to go into. It may work in the short term, but remember that's that NASDAQ versus gold, also oil versus gold and all that. I think those are the ones that you want to be in. I think Bitcoin is just an extension of the NASDAQ and that type of market condition. I don't think it will work in the market condition that is coming. I could be proved wrong because we don't have any data on it, but that is my guesstimate or my opinion on it. If I were to price, let's just do gold divided by Bitcoin priced in dollars. So obviously we've got this gigantic downward move, but what does that look like? That's a double bottom. That, my friends, is a double bottom. So there's your wedge, there's your breakout, there's your double bottom. That's gold versus Bitcoin. Gold's about to outperform Bitcoin. Now, silver's going to outperform gold, and platinum, I think, might outperform everything. So that's the double bottom, that's the wedge. That's exactly what we're seeing in all these different charts that I'm showing. And this is not going to feel good. People are so misallocated. And when this starts to go up, let me try to describe what is going to occur. My best estimation. Things are going to feel different. You're going to go to the store, you're going to say, holy crap, why does everything cost so much? Well, that's already occurring. Then people are going to start to sell things that they don't, that they want, but they don't need. So they start selling things or not buying things that they want uh, because they have to buy the things that they need. And then the world's going to have to reconfigure itself where more people are going to have to go to producing things that people need versus want. And that could be whatever it is, precious metals and energy and whatever else, right? And on the right hand side, people are going to start to FOMO over here. They're going to start to FOMO into gold, silver, platinum, palladium, uh, oil and hard assets, copper, everything. And I'm not even sure that this is going to feel like the 70s. I think it could be, I don't know. I think it could be different. It could be a lot worse. Is what I mean by different. The intensity could be much greater. What could happen, and I don't know if this is going to happen, but what could happen is that financial assets have problems. Bonds in particular, and the equity markets are going to have problems because if people realize that scarcity is more of a concern, that the price to earnings ratios and the valuations that are currently and maybe even historically have been given to financial assets are completely off, and that those who own the hard assets that go into making usable products should be completely repriced. Maybe, but that's kind of what it looks like to me, that there's going to be a gigantic repricing of hard assets here. So this guy, he's going to be wrong again. He's going to be wrong again, and maybe in another, 20 years he'll figure that out. I don't know. Daniel says, just understand a simple concept. Uranium in the ground is useless. Getting it to you comes at a cost. Known pounds and available pounds are different things. And there's the cost of production. There are no short, medium-term projects that can meet demand at low prices. Yeah, I totally agree. And if we get, so when I look out, I try, I'm not looking out 12 months or 18 months. I'm looking out like 5 to 10 years. I look out 5 to 10 years and I ask myself, do I really think that we have the oil projects out there to support demand? My answer is no. I don't think we do. I don't think we do at whatever price you want to set oil. Like I think we could maybe fudge it for like 5 years or something. I don't know about 10. So maybe we can fudge it and we can like yank oil out of really small, little holes all over the place. Maybe we can rework wells and use chemicals and figure out ways to get more oil out of stuff that we've already drilled. I'm sure there's things that we can do. Um, I don't know if we can go 120 million barrels, 125. I don't know, and that's where we're, basically heading towards. And if we go towards that, I think uranium is going to be a huge, huge play. But the question then becomes this: if uranium really starts to move and people want to use it, what stops people from getting uranium out of the sea? I mean, wouldn't that be good because you can just figure out a way to extract it out of, seawater and do it that way? Why would we need to go into deposits on land? Because once you make it, you can move it wherever you need. You'll be where most people live, which is right, on water, so to speak. So yeah, I don't know. I think that will be an option in the future. Daily compounder. Anyone who studies the history of oil will know a push for OPEC plus gaining share is positive for price. It's bad for consumers. They're going to test the limits of shale. OPEC plus will likely raise oil output again in November as the group continues its strategy to reclaim global market share, people familiar said. Guys, this is probably fake news. It really is. Another thing, usually OPEC increases oil production into strength, not into weakness. So maybe they're seeing what I'm seeing with all those charts. I don't know. Coming down, silver shortage next. The green part is the available silver for delivery on London. Look at that squeezing on up. That's the available silver for delivery on London. Now, somebody had made some comments that silver is going to pause at 50. Oh, we'll get a pullback. Oh, we'll chop sideways, and that very well could be the case. I mean, I'm not stating that that is wrong, but we could also have a problem with the physical market here, and silver gap up, does a gap up at 50 and go straight to 70, 80, 90, $100. We just gap the entire thing. We leapfrog 50 to like $7,500. We get this gigantic gap, and that's everybody getting scared and piling into the trade all at once. And then the banks with their big shorts getting all squeezed to all get out. I don't even know what that means. Like, I don't know what that means for the banks. I don't know what that means for money printing because are they going to bail the banks out? Uh, what happens if the physical metal, like, you can't get it off these exchanges? Do the exchanges go to zero? And how does that impact everything? I mean, let's say that physical gets super tight, industry panics, industry goes out and buys all the physical metal that's out there and starts buying mines. And then everybody panics because the only access to metal is through buying mining shares. Could that occur? Maybe. I mean, it's possible. I'm not claiming that will happen. But I mean, these things are all tightening up. Price generally goes up vertical when things tighten. Is that what we're seeing? Yes, that's what we're seeing in the gold price. That's what we're seeing in silver price. That's what we're going to see in platinum here. I mean, platinum's up what, like 70% this year? What happens if they don't have the metal? Like, what happens if they don't have that? And I don't even know what that means. Like, what does that mean for the banks that have all these big shorts? I mean, are they shorting the futures market because they know the future market is going to go to zero because it's not going to be backed by physical metal? Is that how they win? I don't know. Wouldn't that be ironic? They're actually not trying to suppress silver. They think that the exchange is going to go bankrupt. And they're shorting it because they think the futures price is going to go to zero because they can't physically deliver anything. I don't know. That'd be ironic. Here's John Quakes. If you haven't already, I highly recommend reading Eric S. Townsend's excellent post. That sees a turning point now for the volatile but steadily growing fire under uranium mining stocks in this U bull market. So he thinks that April 2025 was the bear trap and September 2025 is here. I think that is not right. I think September 25 is like right here. It's like in the beginning, right after this April 2025. Um, I think we're going to go up this over the next few years, maybe even decade or longer. But yeah, I do think we went through the bear trap though. That's wave two in Elliott wave, and I think that is done. I think it's April 2025. He's nailed that one. I think this is too far along here, but maybe he means that we are entering this phase. Okay, I get it. This is XLE, which is an energy ETF. Oil and gas stocks ETF XLE is breaking out on its momentum. We are very early in this move, and the sector will perform great. SIC dividends also for great risk reward entries. Yeah. So we're starting to break out here in momentum for XLE, the energy ETF, oil and gas ETF, the big boys. I have some ridiculous chart setups that I was looking at in these smaller oil and gas setups that are incredible entry points right now. Incredible. If this is true, where we're getting this momentum breakout, I think everything is going to start to run soon in oil and nat gas. There are still some incredible entry points on some of these companies in oil and gas. High Heat says investor apathy will continue for the energy sector until it's too late. The impending shale supply fiasco, drainage, will be front page news within the next 2 years, and inflation will be very hot again. Shale will likely be unable to help for round two when oil prices are greater than $120 per barrel. Why do you think there's been 250 billion of merger and acquisition activity in 12 months? Because the majors believe long term is $60 per barrel of oil. OPEC is back in the driver's seat. So yeah, oil's going to go way up. It's going to go way up. And I've got all the charts that support that. Even momentum is saying that we're going to go higher here. Remember, these news articles, like up here that they were talking about oil here, this one, they're all being floated out right now. They're trying to hold oil price down with this. It's not going to work. We're going to launch very, very soon. It's going to be a fun ride. Reads with Robbie says, set goals so high that they demand an entirely different version of you. Now, I don't know if setting the goals is that big, but I think having the mindset that you need to strive more than what you think you can reach. I think that is true. I also think that even if you don't have, let's say, like goals per se, but you set up a process or you're disciplined enough where you just work at something that you like and you just keep doing it, I think that will also get you there. I've never been a goal setting guy. Like I have these things that I want to do in life, so I just work towards them. Uh, some people, I guess they'll call them goals, but I kind of just work towards them and then they fall into place when I think they should fall into place. Like it's not based off time. It's based off of me working, doing things and basically just having a vision, like a vision of what I want to do, but I don't really set these goals. Like I just work towards it. And some people, it's like they're goal oriented. And I'm like, that's not really like having a vision for your life. There was a guy, well, one of my friends, he took a new job. And this was a while back. And I said, well, does it fit within the vision of what you want in your life? And he's like, no, like, so all he wanted to do is he wanted to get the manager title and he wanted to get over $100,000 a year salary. And I was like, well, if it doesn't fit within the vision of what you want in your life, why are you doing it? And what I've found is that people don't have a vision for their life. So it's not about setting goals. His goal was, at least temporarily, his goal was to become a manager, get the title, and make over six figures. He did that. And he said it was the worst decision he made because he absolutely hated working there. He only worked there for like 6 months, and then he had to move somewhere else. And I just looked at it even before he got the job, and I didn't know if it was going to be good or bad. I don't know. I just said, why are you doing it? If it doesn't fit the vision of your life, don't do it. Like, and I think that's what people lack is the vision of the life. So I don't set per se goals. I mean, I've got numbers that I think I would like to hit, but I'm not working towards it because I want to hit those numbers per se. It's like just a measuring stick to see if I'm progressing towards a vision, but I don't know if that's like the ultimate goal because when I hit certain numbers, like they're just arbitrary. Your first $100,000 is like an arbitrary number. Your first million is an arbitrary number. And even if you hit them, it's not like your life just changes. It's like I'm living the same life I did before that. So I don't really, I don't know what these, how can I say this? Even if you set goals, your life may not materially change at all. And even if you're living, let's say you're living a very good life, even if you have all this money, your life probably won't materially change. So what's the point of it all to do it anyway? It's all just kind of fictitious goal setting numbers that don't really mean much. And it also might mean that most people are so rich they just don't realize it. That we are living better than gods did, or kings, I should say, and maybe not gods, but kings back in the day, and we just don't realize that. Here's another one from Dear Son. No iPhone before $10,000 net worth, no car before $50,000 net worth, and no house before $200,000 net worth. Three simple rules for financial peace. Well, I didn't have an iPhone, but I just had a regular flip phone for a little bit. But I got 10,000 net worth real quick when I started working. I even hit 50,000 net worth. I think in the first year I started, well, maybe not first year, but probably like 1.5, 2 years, I hit probably $50,000 net worth. And then 200,000, I probably hit that after, 3, 4, 5 years, something like that. Um, and then I didn't buy a house right then and there, but yeah, I hit those goals and I just used it because I wanted the safety net. I felt like it was safer to have that than it was to not have that. Metals weekly price, palladium and platinum. The platinum group metals just ripping up about 12%. Silver's up 8 point something percent there, 8.6 or so. Uranium up 6. The losers, antimony, molybdenum, nickel, aluminum. Well, aluminum's basically flat, not too much of a loser. Here's Peter Lynch. He says, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. Those who are worriers prevent themselves from basically ultimate success. The worries. Charlie Munger, the game of investing is one of making better predictions about the future than other people. How are you going to do that? One way is to limit your tries to areas of competence. If you try to predict the future of everything, you attempt too much. Well, it's not about making better predictions, in my opinion. I don't know if Charlie Munger is necessarily 100% right on this. Um, I think the game of investing is looking at the world differently than other people, or maybe taking a longer time frame. And if you look at the world differently and you're patient and you're looking at things a little bit different, you see things that others don't. You pay attention to things that people aren't. And you just look at things a little bit different. That's what I'd like to think of myself when I look at things. I just look at things, I look at ratios, I do all this, and I'm like, yeah, it's just a matter of time for all this cycle turns. But it's going to take time. And that's where people, they're going to say, oh, well, it didn't happen in 2 weeks, so you're wrong. It's like 2 weeks, that's nothing. I mean, think of the projects at like big projects that people do. They're not done in weeks, they're done in years. Really, really big projects. So, yeah, I think time frame is a big one. Here's game changer to oil views. IEA have and continue to forecast a wave of oil supply, but Vortexa is not seeing that wave of oil at sea. It's the supply side that's driving prices. Everybody has basically been telling you for 2 to 3 years' time there is a wave of new supply that is coming into the market in the millions, basically. And the reality is, we don't see that at sea. Even though oil demand growth may be closer to IEA than OPEC, lesser than forecast supply at sea is the more important oil price factor. It should change oil views if people no longer accept as a given the IEA at all forecast for wave of new oil supply. So they're not seeing it being, in the tankers. Where is it? If we have all this supply, why isn't it being shipped? I don't know. That's all I've got for today. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special that coupon code. And that's all I've got for today. So we'll see you guys. See ya.